are some of the most deceptive and manipulative tools used in the market. At the core, big wicks represent areas where the price moved significantly in one direction but failed to hold. The long wick shows price rejection, meaning it reached a point where the market didn't want to stay. This happens because large players are moving the price to trigger certain actions from retail traders. Big players know where most retail traders place their stop losses or where breakout traders are waiting to enter. And by pushing the price to these levels, they can activate these orders only to reverse the price and trap those traders. The wick is the aftermath of this manipulation. The manipulation works because most novice traders react to price movements without considering the intention behind them. The big players push the price up or down aggressively, creating a sense of urgency. Traders see this sudden move and think they're missing out on a potential breakout or trend continuation. The wick itself is the result of this push. Breakout traders also enter the market, thinking the move is real. At the same time, traders who had their stop losses set just beyond key levels get forced out of their trades. These traders think the market is breaking out of a range or continuing in a strong direction. And once the big players have triggered enough orders and collected liquidity, they reverse the price. The candle closes far from the extreme point of the wick, showing a large rejection of that price level. Retail traders who entered the market on the breakout are now trapped in losing positions, while those who got stopped out are left frustrated. This manipulation relies on the fact that traders tend to follow price blindly without understanding that the price move was intentionally created to trap them. Once you understand how this manipulation works, you can use it to your advantage. First, don't jump into trades just because the price moves past a key level. Instead, wait to see how the candle closes. If the candle has a big wick and closes near its opening price, indicating rejection, this is a sign that the previous breakout might be false. You can then consider entering a trade in the opposite direction. Second, big wicks often occur around major levels. These are areas where big players know that traders have placed their stop losses or breakout orders. If you see a long wick forming at a key level, it's a sign that the big players are hunting for liquidity. You can use this as a signal to enter a trade in the opposite direction of the wick. Also, wicks are more common during certain phases of the market. In consolidation phases, big players are accumulating positions, and they use wicks to mislead traders into thinking the market is breaking out.